All right. Thank you very much for tuning in. Welcome to Grinnell Capital webinar. We've been doing quite a few of these. They all kind of seem to be pretty timely and hopefully pretty important. Hopefully the content is value added for you. Welcome to our financial advisor partners. Welcome to our investors. Welcome to our family office partners. For those of you new to us, we publish financial models, investment models, and help our financial advisor partners and all of our investors achieve success through those models. Also, shout out to our new friends from Future Proof we just met. Hope you guys are tuning in. All right, let's get rolling. So we're going to talk a little bit about the Fed, a little about what's going on here, try to make sense of the current environment. So the branding, I just want to touch on that super quick. Active investing in the stock pickers market. I couldn't feel more strongly about those lines in terms of the current environment we are in. We do feel very strongly that now that the Fed obviously has gone from the easy money policy to a tight money policy, I do think that stock and sector selection is going to be extremely germane to your success out there for you and your clients, and stock picking is back. Agenda for today, real quick. We're going to talk about the earnings bear market, which is coming up next, we believe. How we got here, a couple trends we're keeping an eye on. We're going to talk about stress testing the S&P 500 in terms of earnings per share, and we'll talk about that exercise and the implications thereof, navigating the market and potential outcomes. So the title of today's call, Bear Bottomed Earnings, You Make the Tail Risk Go Up. That's not my invention. You guys know the Queen song that's kind of rhymes along with that, same title, right? But catchy, you get the idea, right? Tail risk potentially on the rise a little bit from the current environment. Everybody's a little bit nervous out there. No doubt clients are nervous. So we'll talk about these things. So yeah, up next, earnings bear market. So the reason that's there is most of the drawdown we've experienced in 2022 has been call it the interest rate bear market. We've had a Fed who's pivoted last November. They went from, as you all know, thinking inflation was transitory, getting some religion around that, and obviously knowing that's like the biggest risk going forward. We've seen Fed funds increase 2.25% thus far in 2022. Current Fed funds futures are discounting a rate of about, that says 3.39 by Jan 23. I put these slides together before the most recent CPI report, so that's probably a little stale. That number is probably closer to 4% for a Jan 23 in terms of Fed funds. So really implying like 1.25 to 1.75 more rate hikes from here until year end. I put this historic Fed fund rates chart up there for fun. Just to kind of give you a clue of where we've been. We've had much higher Fed fund rates in the past, and the market has been pretty well footed, absent a few years here and there. So, not the end of the world, but certainly a process we've got to get through. So, how did we get here? This is nothing new. Stimulus from the Fed and the government pumped into the economy and consumers' bank accounts. A lot of that went right into risk assets. So we saw huge returns coming out of 20 into 21. Ongoing supply chain disruptions have obviously led to rising inflation as well. So interest rates rise. Two trends we're keeping an eye on here, and one of them has kind of been really expressed so far in the marketplace, and the other one is probably just starting to express itself. So the first one, multiple compression, that's really been the first part of this bear market. When we talk about this interest rate driven bear, that's what's happened. You've had the multiple compression in stocks, in the S&P, in the NASDAQ. Reason being, all of a sudden now the return of risk, the risk-free return on your capital went from essentially nothing to basically 4% now, right? The 2-year, I believe, is right around 4%. The 1-year Treasury is over 4%. So you went from an environment where you could get absolutely nothing risk-free. Now you can get a real return risk-free. When that happens, the multiple of stocks decreases. We've seen that, right? We look at a trailing PE ratio here. 35 was kind of the peak back in 2020, early 21, and now we're 19.75. So the compression has happened. Doesn't mean it's over. But if, for me, probably seventh inning of the multiple compression phase of this deal. Rising cost of capital is the other big consequence of rising rates. So that's going to come to roost. I think that's going to be a later 22 into 23 event. You're going to see companies that don't have the strongest balance sheets, that are, otherwise doing pretty well in terms of cash flows, actually have cash flows, but the balance sheets maybe aren't that great. And they've got debt maturities coming up in the next year or two, right? Next 6, 12, 18 months. Those guys could be in deep trouble when they've got to refinance that debt and they have to pay more for that debt. Rising cost of capital. Debt costs more. Ask somebody right now who's shopping for a new house. What does that feel like versus like a year ago? It's a completely different experience with a 6 and change 30-year fixed versus 3. Rising cost of capital. That's now obviously an impedance to some areas of the market. So, we thought it made sense. And some other high-profile shops have done the same exercise. We actually did our exercise before they did. We'll talk about that. But we thought it made sense to stress test the S&P 500 in terms of earnings, what it could look like, where could this thing maybe go, just taking averages from the past. So why did we do this? Well, we've had some signals from different areas of the market. Semiconductors, for those of you that know me, I love semiconductors. They are, in my opinion, the best leading indicator of what's happening in the economy. They lead the way down, they lead the way up. You get a lot of false starts along the way, but invariably semis lead the way. We've had warnings from several semiconductor companies now: Micron, Intel, NVIDIA, AMD. Not all of them, but any one of them or a couple of them have talked about rising inventories, decreased end demand, functions of slowing demand. Also on the enterprise, so you've had enterprises managing expenses. So that's been the language out of CEOs on conference calls, talking about the appetite of their customers. Well, they're looking into managing expenses more now than they were in the past. In other words, they're being more careful with their spending. Benioff used that commentary in his call. It's really having to go higher up the ladder in that C-suite to get a piece of business done. Used to be just a chief technology officer would sign off on a new Salesforce piece of business. Now it's got to go up to the CFO to see if it makes sense. Okta CEO Todd McKinnon had similar commentary. He saw elongated sales cycles. It's all the same language for less business is getting done. It's trickier to get business done. So that's enterprise commentary. Semis is retail. It's kind of everything. I don't have to remind you guys, we saw Walmart and Target both blow up earlier this year. So we already know that the consumer's under stress. So everybody's kind of a part of this thing now in terms of feeling stress in the marketplace, in the economy. Here's another example. So there's a consulting firm that their clients are home builders, their clients are other real estate oriented companies. They surveyed 1,000 real estate agents. This data is not out yet in terms of their findings, but this is July data. And all their questions are simple. What direction have home prices moved in the last month? And you see the graph there. Are they mostly decreasing, mostly flat, mostly increasing? We went from this environment of hardly anything decreasing. Now, all of a sudden, each month, it's getting a little bit worse in terms of those prices are decreasing. It totally makes sense, right? Mortgages over 6%. I think they're like 6.5% now, the 30-year. Housing is almost 17% of U.S. GDP. This is a big component. So as this slows down, it's gonna trickle down. So moving on to our earnings stress test. For those of you that get our newsletter, we did have this exercise in there. It's pretty simple. So I'll walk you through it real quick. 2022 consensus EPS for the S&P 500 is 225. I believe it's still right around 225 in earnings. Ed Yardeni has a great research firm that he's been around forever. He tends to be pretty measured. He also tends to be pretty optimistic. And he's at 215 for 2022 EPS. So we're going to use Ed's number of 215 for our exercise. So if we look back in history, earnings corrections from peak earnings to trough earnings during a recession, we're going to just go ahead and pretend there's going to be a recession later this year, early next year, is 26% on average. Peak to trough earnings decline. So you take 26% off of 215, that gives you 159 in earnings for the S&P 500, $159. Average multiple of earnings at a trough has been 18 and a half times. Now that can be a little bit lower in a rising rate environment, but in general, let's just work with the averages. 18 and a half times. This incorporates recessions from 1990, 2000, 2001, 2020, 08. So 159 times 18 and a half gives you 3,000. That's just kind of and I said before, there's been other firms that have done an exercise that's similar. Guggenheim, Scott Minerd came out, I think he just came out last week and said this thing's, we're going to go to 3,000 by the end of October. Dan Niles has been pretty bearish. He's had 3,000 for a target for a while. We were just in Future Proof, saw Jeff Gunlock on stage. He kind of echoed that 3,000 number, made sense to him. And this is, honestly, this isn't proprietary stuff here. We're just kind of giving you an example. That's kind of how you get there. It's really not that hard. You take averages, you plug them in, assume that earnings. So is this better than the interest rate bear? So the earnings bear seems like a ridiculous question, but in my mind, the way that my brain works, it is better. Meaning that earnings-related pullbacks are more logical. You can handicap them a lot better than you can just pure multiple compression. Correlation first half of this year was pretty close to 1 for almost the entire market, ex energy and utilities and healthcare to some extent. Some of that's probably going to continue, but we do think you're going to see less overall correlation. Is not going to be 1 or 0.95 in the market. There is going to be an opportunity for stock picking. We'll talk about that. So still areas to avoid, in my opinion, right now. Cyclicals, too early. Semis, industrials, love semis. I'll be one of the first guys to get back on board, and I'll tell you when I do. It's not yet. Expensive, unprofitable tech. That goes back into that second phase of the two trends with rising interest rates we talked about, increased cost of capital. This is not a great time for these guys. There'll be some exceptions to that, where the snowflakes of the world, the next generation, most amazing stuff, potentially. I still think it's a little early. Consumer discretionary, I think consumers going to be really going to have a real tough time over the next 6 months. Software, as much as I do love software and the model therein, I've talked about it. Those of you listen to our podcast, we do talk about mission critical software as an area that we do have liked. We do continue to like it for small exposure. You want to nibble. For me, that mission critical stuff, by and large, is cybersecurity. You want to look at the Palo Alto networks of the world. You can put a PE on that thing, even though it's a little expensive. Zscaler is another one. I'm getting excited. I'm getting a cue that I'm a little fired up. Zscaler is another one. We own that one as well, and we will look at more throughout the rest of this year. Home building is another area I think that makes sense to avoid still, as cheap and tempting as they might be. And the space has held up really well. Maybe that's part of the reason, is they really took the brunt of the interest rate multiple compression back in the early part of this year when rates really started to tick up. So they've kind of gotten their butt kicked, but I still think it's early there. Positioning ideas, so potential longs, healthcare, large pharma, select biotech has worked really well this year. I still think it works, absent little bouts of profit taking. Med device, I think, is compelling. Those of you who listen to our podcast, we've been talking about med device. IHI is a really simple way to play it via ETF. Med device has lagged broader healthcare, definitely lagged pharma, supply chain problems, staffing problems. Those things seem to be on the mend, so that's an area to take a look at. Energy, I think, could still work, especially given the pullback. You've got secular situations in terms of maintenance and CapEx that just has not been spent to bring on new capacity in that industry for years. It's all about ESG. It's not quite all about ESG yet, is what people are finding out, but that's been the mantra. Agriculture, again, secular drivers. In terms of some areas in agriculture, like fertilizer, I'm not sure anybody's buying potash from Russia, ex-China, ex-India anytime soon. That looks interesting for like a Mosaic or a CF. Extremely strong cash flows, very reasonable multiples of earnings. Engineering, E&C stands for engineering and construction. The Inflation Reduction Bill infrastructure that got passed recently, there's going to be initiatives towards that space, specifically on electricity transmission, distribution, things of that nature that utilities often spend money on. There's one of our largest holding is Quanta Services, PWR. is the ticker there. It's not, we own it. It's hard to recommend right here because it's held up really well, but we still own it. We'll probably add to it on pullbacks. But those are kind of some examples, I think, of things that can work as you go into the rest of the year. We'll talk a little bit more towards the end about some other things that might work. Extreme pessimism may bring opportunity to trade around positions. So one of the things that we think makes sense to do when you have an environment where you've got some serious pessimism going is you get situations where you get the market that takes a huge decline, and there are names that should not be down with the market, should not be down with that tape. You've done the work, these positions. Those are times to add. And the flip side goes for when the market goes on its huge tears. So there's some that believe that after the Fed decision tomorrow, we're in for a real face-ripping rally to the upside. Possible. I think the positioning would dictate that's not out of the question. What's happening? Are we good? Oh, okay. IT department just had to double check here. So anyway, trading around positions simply means being able to opportunistically add to existing holdings, and at the same time trim where that they've run a little bit too far, too fast in the current environment. You got to still assume bear market. You've got to assume lower levels are coming. I just think that's the smart move. This is just a quick graph, just speaking of pessimism. In late August, when the market started selling off again pretty good, there was some hedging, some put positions that were bought. And this is a pretty incredible example of just how much was put on the hedges in that late August timeframe. Just buying puts in the marketplace is really what that's in reference to. Could be an example of why the VIX has been relatively tame so far. People have done a lot of their hedging, maybe not a lot of fear anymore. I don't know. We'll see. So potential outcomes from where we are, in our opinion: one, inflation remains stubbornly elevated, as the most recent CPI would attest to. We've got the rent component in there, the wage component in there is significant, and that is not coming down anytime soon, though other areas no doubt are coming down. You look at commodity prices, you look at even things in the grocery store, they are starting to come down in price, which is fantastic. But inflation remains stubbornly elevated, is a potential, makes the Fed potentially hike longer than expected, hike more than expected, what have you. That would number two, the Fed blinks. And what do I mean by that? So you've got a situation where I think that there's some serious macro deterioration going on currently. We've shown slides that example: home prices, where mortgage rates have gone, what the enterprise is thinking, doing, what it's like for really cyclical industries like semiconductors. So the Fed's not ignorant of these things. They may, in fact, see how fast and how far this economy is pulling back, the rapidity, I guess, of deterioration, if you will. That could lead them to not pause, tomorrow. They'll probably talk some hawkish game, but even if there's a glimmer of something talking about being data dependent for the next set, what have you, the market's going to interpret that as maybe the Fed taking a foot off of the brake. And the Fed, that may be something that causes a lift in equities temporarily. But so the Fed blinking, that could be something that happens. Number three, inflation comes down at a pace faster than the market and or the Fed expects. Now this has actually started to get some dialogue around Wall Street. Some of the smartest folks really think that we're going to be looking at deflation in 12 months. I'll go back to Gunlock. He was on stage at Future Proof last week, and that's honestly, he thinks like in a year from now we're going to be looking at a deflationary environment for the U.S., for the economy. That would line up with what I had just said, with given the rapidity of the declines that we're seeing out there in terms of fundamental trends. That would totally make sense. That would be, either sounds terrible, but that would actually be quite good. Fed's work is done. I'm going to go and just opine here for a quick second. You've got a 2-year right now that's, let's just call it 4%. What is it, 3.9, 3.98, whatever. The 1 year's over 4. It feels like the market isn't necessarily needing a interest rate over 4% for Fed funds, right? The 2-year really leads the way for Fed funds. It kind of feels like that's the level. 4% might be the level. And that's maybe where Fed funds has to get to, right around that level. Maybe not necessarily too far over there, because by that point, and that's going to be later this year, but maybe that is when you start to see these deflationary trends really starting to take hold in the U.S. economy, and it becomes fairly obvious that we don't need to keep the boot on the throat of the U.S. Do you like that, boot on the throat? Much longer, come early first half of 23, right? So for me, that makes sense to me. I mean, we know from 70s and 80s, inflation can be really stubborn. So we'll see, but I do that deflationary argument does ring true with me. So in terms of potentially actionable ideas, you look at 1-2 year short duration treasuries. I think the SHV, the SHOV SHV iShares 1-3. It's a legacy Lehman ETF. God rest the brothers. That is one that you could pick up here and get that around 4% yield, with the thought of maybe there's not much more downside to go in something like that short duration treasury. But have a shopping list ready. I've got it written right there. I can't say this enough. If you're not buying stocks over the next 6 months, you're doing it wrong. This is the time. If you're not putting, if you're an investor, you're not putting money to work. If you're a financial advisor, if you run a family office, whatever you're like me, if you're not putting money to work over the next 6 months, you're doing it wrong. This is the time. You get these huge corrections, you get these bear bottoms, or not bottoms, you get these bear markets. This is the time to put capital to work. There's the classic saying rings so true. When it comes time to buy, you're not going to want to, and that's the truth. There's going to be a day, but it's going to just look like, oh my God, this is the worst environment ever. And the next day, you know what you're going to see? Warren Buffett buys 15% of XYZ company, and boom, and that's the bottom. I'm not saying that's going to happen, but that's the kind of stuff that can happen. Someone like him, he loves that environment, right? So you got to train yourself to really appreciate the opportunity given you by downdrafts in the marketplace. So have that shopping list ready. If you need help, reach out to us. We are happy to help. That's me, Frank Grinnell. I don't think I introduced myself. I am the CIO. I am the portfolio manager. My co-founder, better looking and more intelligent half of the team, is my wife, Dana Grinnell, business strategy operations leader, juggernaut person in general. You should get to know her. I know her quite well. She's a great person. So yeah, get in touch. Honestly, we'd love to get a dialogue going. If this is an area you want to have help with, this is why we exist. We've got a website. Everybody's got a website. We do a daily podcast. So unlike a lot of podcasts, it might take 45 minutes. We take about 7. So things that I think are relevant out there for the day that we're looking at, we'll retouch up on current themes that we've been working on, tell you how that's going, whatever. Daily podcast, tune into that. We're on LinkedIn. You can access the podcast through LinkedIn, YouTube, which is where you are right now, obviously there. Reach out, request a copy of our fact sheet. Love to share information with you, show you how we're doing. Subscribe to what? Everything? What do they subscribe to? Everything. YouTube. Subscribe to YouTube. Hit the subscribe button. Thank you. I think that's it. So I hope you got something out of this. These are our disclosures. I'm going to leave it there. Have an awesome, happy Fed Day tomorrow. And that's it. Now I just got to find out how to, boom.